Hi, welcome to Jason FinTips. I'm Jason and I'll be your host. Today I want to talk about marginal tax planning and Roth versus or traditional. But before we get going, I just have a quick little disclosure we need to do here. Disclaimer. This content shared during this video is for information, educational, and entertainment purposes only. It is not financial, tax, legal, investment, insurance, political, or medical advice. No personal recommendations are being made, and nothing presented should be interpreted as a solicitation, endorsement, or guarantee of results. Although I do hold the CFP, CLU, and ChFC designations, I am not acting as a financial advisor, insurance advisor, fiduciary, tax professional, or legal representative through this platform. All examples, case studies, and scenarios are hypothetical and intended for illustrated financial principles only. Viewing or engaging this video does not create an advisor-client relationship, a fiduciary-client relationship, an insurance advisor-client relationship, or a plan-client relationship. Always consult your own licensed professional for advice specific to your individual circumstances. Our full disclosure can be found at jasonfintips.com/legal. And with that, let's dive into marginal tax planning. So, couple quick ones if you're not going to be here for the whole time. A couple things we want to talk about. 5 key takeaways, to get out of here real quick is to know the difference between a marginal and effective tax rates. Marginal tax rates is the tax you pay on the last dollar earned. The effective tax rate is your overall average tax rates. Both matter, but marginal tax rate drives contribution decisions. Traditional IRA contributions save your money today. Roth IRA conditions trade today's taxes for tomorrow's freedom. Timing of taxes is everything. We're going to really look into that. And flexibility oftentimes wins. And with that, let's dive into dive into the topic. A lot of people get the question of should I choose a traditional or a Roth IRA, or you have a 401k at work that not only has a traditional 401k, but you also maybe have a Roth option. So how does your tax bracket today look? So one of the questions I would start thinking about asking is, someone might consider asking themselves is, how does my tax bracket today look compared to my tax bracket in retirement? Making the right choices can mean saving tens of thousands of dollars over the course of your lifetime. We'll break down the key differences between a Roth and traditional IRAs, the critical distinction between marginal and effective tax rates. We're going to dive into that. We'll also look at some examples, including some levels of Social Security averages to help you see what actually might work out in practice. So with that, let's dive into what is marginal tax planning. At its core, marginal tax planning is about making retirement and tax decisions that minimize your overall tax burden by strategically timing when you pay taxes. So you're deciding when I pay tax. You're going to have to pay taxes, but the question is, how am I going to decide to be effective in paying on my taxes to recognize income? Marginal tax rate versus a tax. Kind of take a look out here. The tax rate applied to your last dollar earned is marginal tax rate. Determines how much additional tax you owe when you receive an additional extra dollar of income. It drives incremental decisions. Should I take a deduction now, or maybe I should wait till later? Your effective tax rate is your average tax rate. It's the total taxes owed but divided by your total income. This provides a much more big holistic picture and view your tax burden. It smooths out the distortions of the tax bracket deductions. So let's take a look at an example here. Let me get a quick little bit of water here. Suppose that you have a taxable income of $100,000 and you pay $18,000 in income tax. The effective tax rate is 18%, 18,000 divided by 100,000. But when you look at each additional $1,000 earned, pushes you into a higher tax bracket, you might be taxed at, say, the 24%. So your marginal tax rate would be 24%, but your effective tax rate would be 18%. And you can help this effective tax rate helps you understand what proportion of your total income is going to be taxed, but your marginal tax rate helps you decide whether additional income or tax strategies are worth it. Why marginal tax planning matters, especially for IRAs. Once you kind of get those two ideas of those two different rates, traditionals versus IRA 401k contributions, today reduces your taxable income today, generating tax savings equal to your current marginal effective rate. For example, if your current marginal effective rate is 24%, a $5,000 deductible contribution shaves about $1,200 off your current taxes. A Roth IRA or a Roth 401k contribution doesn't yield any immediate tax savings because they're made with after-tax dollars. Instead, of benefit comes from later when you pull the assets out, the tax-free withdrawal and retirement if certain conditions are met. So the core principle here is to try to pay taxes when your marginal tax rate is the lowest. That's either favoring a traditional or a Roth, depending on your individual circumstances. And it also comes into individual states as well, because state income taxes play into this. When Roth makes sense, when Roth makes sense and when a traditional might be better. If you expect to be in a higher tax rate in retirement, then it might make a Roth can lock in today's lower rate and it might look a little better. If you expect to be rate in retirement to be a lower tax rate, then a traditional might make more sense, deferring taxes into the future when you have to pay at a lower rate. In some years, you may be in a low tax opportunity. You might be a business owner and take a big bath year and you have a low income. That might be a year where Roth contributions might be especially attractive. Don't forget, tax law is uncertain. Decisions weigh possibility of future changes of rates, income trajectories, and personal preferences. So there's no certainty. The only certainty is that we don't know what's going to happen. But that's something where you might want to try to build. Someone might try to build flexibility into a retirement income plan. Traditional IRA offers the traditional IRA base or traditional 401k does tax deductible contribution, tax deferred growth, taxable withdrawals. So the income, you're going to basically defer the income until you withdraw it. And when you withdraw, you're going to actually constructively receive that income and pay taxes on it. Required minimum distributions starting at every 73, forcing withdrawals whether you need the money or not. Now, here's one other thing. For the vast majority, there's high income workers that are going to be doing that. But for the vast majority of earners, the requirement minimum distribution to 73, majority of workers do not retire and start taking retirement because they want to. They physically have to take retirement at an earlier age. So for the vast majority of workers, more likely than not, you're a construction worker, you're going to be retired because your body's no longer physically able to do the work until age 73. So you might be taking withdrawals out at 62, or you might go into 73. It depends on when that requirement minimum distribution. If you can optimize it and say, I'm in a really high tax bracket, I need the requirement distribution, and I don't do it to 73, it might be part of a strategy that's tied into Social Security planning as well. But requirement minimum distribution, the government has said, we're going to let you defer taxes and income in these until age 73, and then we're doing mandatory forced withdrawals. You have to take your mandatory RMDs. This can be ideal if you're in a higher tax bracket now, but expect to be in a lower income tax bracket. You say, I'm going to work till I'm 65, I'm in a higher income tax rate, I do some conversions. This might be a strategy. Roth IRAs, paying taxes now for tax-free withdrawals. A Roth IRA works in essentially the reverse. Contributions are taxed after tax, no deduction today, but you get tax-free growth, no RMDs for the current owner. Distributions don't affect Social Security taxation or Medicare premiums. This can be powerful if you expect to be in a higher tax rate or in a retirement or want flexibility. Pros and cons of a Roth versus a traditional. Factor, upfront tax savings for a traditional IRA. There's no deduction for a Roth IRA. Tax-free withdrawals out of a traditional IRA? No. You pull the money out, you're going to be paying taxes on it. Is it going to be tax-free out of a Roth IRA? Yes. Are there RMDs at age 73? Yes. A Roth does not have an RMD. Effects on Social Security. This is the big one that starts getting into planning. Traditional IRA withdrawals will count as income and may possibly increase the rate in which you include Social Security tax inclusion. So on a Roth, it doesn't affect Social Security. Flexibility and benefits. Traditional is moderate. There's a lot of flexibility within a Roth. So a traditional is best if you expect to be in a lower tax rate in retirement. A Roth if you expect to be in a higher tax rate in retirement at the basics. Working year average income. Let's assume a household's earning $100,000 annually. During their working years, they're doing a MFJ, married filing jointly. In 2025, the income they puts them in the 22% marginal tax break. Every dollar they contribute to a traditional IRA saves them about 22 cents in federal income taxes. A Roth contribution doesn't lower taxes today, but it says a powerful benefit. The withdrawals when they go into retirement are going to be tax-free. This key decision in your working year is about timing. You don't want the tax breaks you don't want to take the tax breaks at your marginal rate. You would rather pay them now and enjoy tax-free withdrawals. Other considerations: if your employer offers a 401k match, these contributions are essentially free money. Some states can amplify the decision in higher state taxes. The upfront savings from traditional contributions may be larger. Career trajectory matters. If you're expecting to get big increases, promotions, or expecting to have a much higher long earning income when you get older, contributions today may pay off when you're later in a later tax bracket. In retirement years, average income with Social Security. Now let's kind of take a look at forward to retirement, kind of taking a look at the same couple. Average Social Security benefit of 2025 is about $1,900 a month, or about $45,600 a year. If they withdraw $20,000 annually from their IRA, their total income would be about $65,000. After standard deduction, their taxable income may place them in the 12% tax brackets. This means during the working years, they were in the 22% bracket, but in retirement, they may be in the 12% bracket. This gap makes the traditional contribution seem more attractive. Since they save at 22% while working, they only pay 12% when they withdraw it. But this does not fit everyone. High savers with larger retirement balances may have a larger requirement in distributions that push them into a higher tax bracket. You may have capital gains, a pension, some rental income can also stack on top of those draws, bumping retirees back into a higher income tax bracket of 22 to 24 or 32%. Medical surcharges may apply if income comes across thresholds, making Roth withdrawals more valuable since they don't count as taxable income. Planning takeaways. It's really just about now versus later. A strategy is to model both phases of life, factoring in Social Security, pensions, investments, RMDs, inheritances that may go into that. Many planners recommend both a Roth and a traditional bucket so that they have a little bit of flexibility. And what this is basically saying is we don't know what the future is going to hold, but we'd like to give ourselves some options so that we can do some planning when we get older. Kind of a quick little side by side here. A Roth contributions are the contributions that are traditional are pre-tax and they're deductible today. And a Roth, they are not. They are after-tax dollars and not deductible today. And a traditional, they grow tax deferred. And a Roth IRA is it grows tax-free. Withdrawals at retirement are taxable at retirement, and a Roth, they are tax-free if qualified. RMDs and a traditional start at age 73, and Roth IRAs are not required. Best for traditionals are best for high income earners expecting to be in a lower tax bracket in retirement. A Roth IRA might be better for younger workers expecting to be in a higher tax bracket in retirement. Example 2. Let's say you have an income 100K income while working and 65K in retirement with Social Security. So your working years, you're about 22% tax bracket. Your retirement years about 12%. So in a traditional, 22% you save 22% on the contribution. That if you did a Roth, you'd have to pay the $1,000, you'd pay the 22% taxes. In a retirement years, your withdrawals are taxed at 12%, but in a Roth, the withdrawals are tax fees. The net effect in this kind of market would be the tax savings in the bracket makes it lower than it would be for the Roth. So someone might be, maybe a traditional IRA might be a better fit for someone in that specific financial situation. We also want to look at the effect of income on Medicare. This is something I don't think people think about. Excuse me here. Your income in retirement just turned by your tax bracket. It can also affect your Medicare premiums. These premiums are based on your MAGI, or your modified adjusted gross income, which includes things like your IRA withdrawals, conversions, capital gains, income-related monthly adjustments amounts. So if your MAGI exceeds a certain threshold, Medicare Part B and Medical Part D premiums increase. Traditional impact. Withdrawals count as taxable income and can push you into a higher IRMAA bracket. A Roth advantage. Qualified withdrawals don't count as taxable income, which can help keep Medicare costs lower in retirement. So a planning tip: managing withdrawals and conversions carefully can help you avoid unexpected Medicare premium surcharges. That's timing of Roth conversions before age 65 when Medicare begins is often a smart strategy. The effects of capital gains tax. If you have a stock portfolio that's not held inside a retirement fund, it's a regular brokerage account, and what's going to happen? Capital gains profits from selling and investments add another layer of complexity to tax planning. The rates you pay depend on the income levels. It could be at the 0% rate, 50% rate, 20%. and then we have the 3.8% net investment income applies to higher earners with Maggie's above the thresholds. Why this matters. Traditional IRAs increase your taxable income, which could push capital gains into a higher tax brackets. Roth IRA withdrawals don't increase taxable income, meaning they won't stack on top of other income to trigger higher capital gains. Planning tip. If you hold taxable investments alongside retirement accounts, coordinate withdrawals to avoid unintentionally pushing capital gains into a higher tax tier. So, kind of some key tax planning tips. Tax bracket arbitrage, contribute to a traditional when your tax rate is high, Roth when a tax rate is low, tax diversification, splitting contributions across both accounts gives you flexibility in retirement, future tax policy. With rising debt, many experts expect higher tax rates in the future, making Roth accounts more appealing. Social Security and Medicare, traditional withdrawals can increase taxable Social Security income and Medicare premiums. Roth withdrawals do not. Who might benefit from these different types of accounts? For a young worker age 25 with a $45,000 a year income, they probably take a look at a Roth IRA. They're in a low tax bracket. They have a lot of time. They can get tax-free, powerful. We don't know. They've got a lot of years to recover. A mid-career career professional with about age 40 with about $100,000 income, they might split between a traditional and a Roth. They have a lot of years ahead. There's a lot of years ahead of them. There's future tax uncertainty. There's different things. So it might be more about a year by year tax planning strategy. Someone's a peak earner, age 50, making about 155, making 150,000 K in income. A traditional IRA or it's traditional 401k saving into that. The big tax savings today, they're working at a career, they plan in retirement, they don't have they don't have a big pension at the job. They know they're going to be living off the distributions, which means they have a big savings today would likely equal lower tax bracket in retirement. So they might consider, I'm going to keep everything inside a 401k or a traditional IRA, and I'm going to pay my taxes in retirement or use some low income years and strategies to eat up the lower income tax brackets so I don't take the hit today at my highest marginal income tax rate. Retirees consider conversions, there's Roth conversions, take advantage of temporary low tax brackets before RMDs kick in. So, examples of marginal tax rate planning in the workplace. A young professional might be working at age 30, making $60,000 income. Current tax bracket likely in the 12 to 20% marginal tax rate. Future income, maybe they've got a family, maybe they don't. As income grows, current career development advancement, the taxpayer may move into a higher tax bracket. Planning a Roth contributions might generally be a smarter choice in this position. You lock in today's relatively low rate and enjoy tax-frees later when your income and likely tax brackets are higher. This also builds long-term tax diversification and early wealth, which compounds into tax-free. The other thing is putting $5,000 away in a Roth is more than putting $5,000 away in a traditional IRA. What that is if you have to pay the money that you put into a $5,000 into a traditional IRA, you still have to pay the money when that comes out. So you're paying, let's say, the 10%. You put 4,500 bucks in there. It's the equivalent of putting more money away inside a Roth. So if you're putting after-tax income, you're essentially saving more money than you are using pre-tax dollars. There's also savers credits and other things in there that you should absolutely look into. High earner near retirement, age 55, they have about 150,000 in income, likely 24 to 32% marginal tax bracket. Future outlook, retirement income may drop significantly once employment ends, pushing them into a lower income. The traditional IRA, or this could be a worker that has a high income, that's a laborer, they know they're not going to be able to work when they retire, their body's wearing out at 60. They might be putting money to save as much as they can in something like a 401k or an IRA to defer taxation. A traditional IRA contributions may be slightly benefit now since immediate tax deduction saves in their current high marginal tax breaks. Withdrawals later may be taxed at lower rates, creating a net win. However, consider requirement distributions at age 73. Also look at Medicare and expenses. So they could even consider a strategic partial Roth conversion before they start collecting Social Security. Middle-aged couple, 45 with $100,000 household income, around a 22% marginal income tax bracket. They might look at something for retirement income be higher than their future outlook. They have uncertain retirement income could be higher if pensions, Social Security, or investment income stacks up, or they have lower if expenses decrease. Tax laws there can be changes in tax laws. A blended approach for someone like this might make sense. Contributions to both a traditional and a Roth accounts for tax diversification and hedge against the future unknowns. This flexibility to withdraw from a Roth in high income years and avoid bracket creep or IMR, the Medicare premium surcharges, and draw from a traditional in lower income years. So they might look for tax diversification, also provide some estate planning benefits for Roth assets that can pass to heirs tax free, while traditional assets may create taxable income for beneficiaries. Retirees on Social Security. They might take a look and say, I'm going to have an IRA withdrawal. I'm age 70. I have $50,000 income. My current tax bracket is likely in the 12 to 22% marginal tax bracket, depending on how much Social Security is taxable and the size of the IRA withdrawals. Income is relatively stable, but required minimum distributions begin at age 73. An increase in taxable income may trigger higher taxes on Medicare surcharges. So there might be a planning takeaway. Traditional IRA withdrawals are taxable, which may push the Social Security benefits into the taxable column or increase it to the 85% inclusion rate. Having some Roth assets allows retirees to pull money tax-free, reducing the risk of higher Medicare premiums or unexpected moving into a higher tax bracket. So strategic Roth conversions in the years between retirement of, let's say, 60 to 70 in RMDs could help smooth out future taxes. Self-employed creator. Let's say that an age 30 hypothetical has a variable income from $40,000 to $120,000. The current bracket varies year by year depending on how the business success. Sometimes you're in a 40,000 at a 12% bracket. Next year you could be in a 24% bracket. Future income is unpredictable and making long-term tax bracket forecasting very challenging. During low year incomes, maybe Roth conversions that can lock in taxes at lower marginal rates. And higher year incomes, traditional IRAs or 401k contributions can reduce taxable income and help manage quarterly tax bills. Flexibility is critical in this situation. Being able to use both a Roth and a traditional option creates a buffer against the ups and downs of creator income. Self-employed individuals may also qualify for a qualified business income deduction, which further complicates tax planning and marginal rate tax planning, which is even more important. So some mistakes to avoid. Assuming retirement equals lower taxes, many people believe their tax bill will automatically drop after they stop working. But with Social Security, pension, RMDs, investment income, your retirement income may actually push you into the same or even a higher tax bracket. Ignoring requirement distributions starting about age 73 can force taxable withdrawals from traditional IRAs and traditional 401ks. This extra income, tax deferred accounts, may make your Social Security taxes more taxable benefits, including taxation, and push you into a higher tax bracket. It could trigger medical surcharge premiums. So also overlooking state taxes. Federal taxes are only part of the story here. Some state tax retirement withdrawals, while others don't. Moving in retirement or failing to plan for state level differences can erode your net income. So kind of putting all your eggs in one basket. Funding only a traditional or a Roth account does reduce your flexibility. Having a mix allows you to switch accounts to withdrawal or depending on your tax rate, income needs, and healthcare costs and requirements. Some steps you might take. Estimate your tax brackets now and in the future. Use online calculators, retirement projectors, and I can't say that. Use a financial planner who's a fiduciary to you and has the planning software and the tools, or even if you're really good with Excel, to get down and do marginal versus effective tax rate to start planning out your futures. There's a lot of great financial planning software to do tax cash flow planning. There are financial planning software that use like a funded ratio, but if you're starting to do some tax flow management on this, you want to work with an advisor that's a fiduciary to you that is also skilled in tax bracket management to kind of model these to kind of come up with some ideas. Tax advantage of lower income years. If you experience a dip in income, job transition, career change early, partially Roth conversion, let's test the funds from a traditional to a Roth and temporarily lower your rate. Build tax diversification into your plan and have a tax diversification statement for you and understand what your plan is going to be. And then plan for Medicare and Social Security interactions. Keep in mind that withdrawals affect surcharges, the IRMMA surcharges, and how they may affect your Social Security and taxable benefits, and how you can be strategic with your draws to help reduce these costs. As always, revisit your strategy annually. This along with, revisiting your tax planning, a little bit of rechecking out your financial plan, making sure that your portfolio is there. Get in there and say, okay, now we're going to take and do a little bit of our tax planning. But once you kind of have an idea how this is set, it should be pretty easy to pop in there and kind of say, this is kind of what my plan and what I think I'm going to happen and where I am. Always work with a professional if you feel uncomfortable. Make sure they're qualified. That's the biggest thing I have to say. A lot of advisors don't do cash flow, tax flow planning on some of this, and not a salesman on this unless they have the proper tools and that's what they focus on. Roth versus traditional IRA ultimately come down to one question: will your tax rate be higher now or in retirement? If you expect a lower tax rate, a traditional IRA may be more better for someone overall. If someone expects a higher tax rate, a Roth IRA may often provide a better long-term value. If you're unsure, possibly a blended approach, which gives you the possibility to make some different decisions as you go along. But it's not just about federal income taxes as well. Smart planning means thinking about requirement distribution, Medicare premiums, capital gains tax rates, the things that are outside the qualified plans, pensions, and then of course state taxes. Which state tax you live in can definitely affect. Someone that lives in a state with a state income tax versus a state sales tax can have very similar finances, but a different financial plan might be needed based off of where they are. The big picture, IRA planning isn't about guessing about the future. It's about trying to build flexibility into your strategy so you can manage taxes over your lifetime to keep more of the money that you've earned. And everything is about using everything that is out there about the tools that we've got and the strategy it can be. So once again, run the numbers on your retirement tax calculators, talk with a certified financial planner that has access to tax cash flow planning software, especially if you're looking at retirement income planning. Look at marginal versus effective tax rate to kind of understand that. And depending on where you are, you could be, I'm 100% Roth, I'm in the middle of a Roth and a traditional, or maybe I want to just have a traditional. It kind of depends on the individual circumstances. The goal is to protect yourself against tax law changes down the road. And thank you very much. Big thing I would say is hopefully that helps you guys out. This is one of the things I really think is marginal tax rate planning. Essentially, and the last thing I'll leave you with is if you have the same exact marginal tax rate before and after, it could actually be the same, to be 15% in on the front end and 15%. But there is different things that are in there that are externalities that need to be taken into account when looking at your plan. So thanks a lot. I know we've gone down in the weeds. This is something that I really like to do. I think there's actually, when they talk about what financial planning is, this marginal tax financial planning is something I think is where a lot of value actually can be added for a good financial planner who does do marginal tax flow, cash flow planning. And it's more like anything else. It's just a roadmap and a guide. It's not actually what's going to ever actually happen, but it helps you put together a map for a strategy within your financial plan to make decisions of what you're going to do and how you're going to manage some of those situations that arise future in your life. Thank you very much and have a great day.